Welcome back. Continuing with corporate conversations then, SIS is the next management. The stock's buzzing in trade today. The company reported a good third quarter result. Dheeraj Singh, who is the CEO at SIS, is joining us on the show now to discuss the quarter gone by and the road ahead for the company. Mr. Singh, good afternoon. Thank you for joining in. In the first 9 months, your top line was around 7%. You ended FY24 at 8.1. What do you end the year with? A, do you expect to see double-digit growth by this year or double-digit growth by FY26?
We've had a CAGR of about 15% for the past 32 quarters, if you see that, right, on revenue as well as EBITDA. And we maintain a similar guidance, but typically we are about 2x of GDP growth has been. And we expect this year to be around that 12%, so it will be in double digits. And going forward also, we would like to maintain similar growth organically, but what would add to it is the inorganic part, leading to the 15 to 16% growth on an average.
Let's talk about that then. Inorganic part is what you've whetted our appetite for. What is it that you're looking at, and what segment? Is it India security? Is it facility management? Is it the international security business? What size? We have a rough idea of it should be incremental of 3% of your revenues, because if you're doing 12% organically and 3% additionally, we have a rough revenue estimate of this. But what are you likely to pay for it? Are you in touch? Anything we can hear in the very near future?
Sure. So our focus remains on India market. Over the past few years, we've increased our EBITDA percentage from India to more than 2/3. So our focus for M&A also will remain for the India market across all the three segments. So as of now, we have signed term sheets for deals in security, facility management, as well as in our cash logistics business. And in terms of timing, we expect to be able to announce hopefully within the next 1 to 3 months, maybe 1 or 2 deals.
Next 1 to 3 months, expecting to announce 1 to 2 deals. That's interesting. You mentioned that you're going to focus on the Indian markets, but your India, the security business domestically, that the margins for that business have remained flat, if I could call it that, or constant for over the last 3 to 4 quarters at around 5.5%. What would you attribute to the fact that these margins are not picking up from where they currently are, or do you expect them to remain at these levels going forward as well?
So from the post-COVID period, where we had security business had reached a margin of about 4%, for the next few quarters, it steadily climbed up to 5.5%. Yes, it's been steady there. One of the main reasons is that we are investing a lot in our technology, both internal as well as our client-facing. One of our business is in the residential alarms business, V-Protect, which is a very high value generator for the future. But like any B2C business, it requires more investment upfront. And that is something that is keeping the margin at the same level for security business as of now.
How much more do you expect to continue investing, and for how long do these margins remain at these levels before they start picking up?
The security business will pick up from the 5.5% to about 6% within the next 2 to 3 quarters. But our focus now has been more on the facility management business, which had been struggling on the margin front, as you're aware, for the past several quarters. The good news out there is now steadily increasing. We are given the guidance it'll be increasing about 0.25% every quarter. And I'm happy to share that it's increased from 4.3% to 4.6%. And I can see confidently this trend continuing for the future.
Closer to 5% by the end of next quarter, and thereafter this quarterly improvement of 25 basis points continues. Just a word on these deals itself. If you could give us a sense of the current cash on your books, roughly what size could these acquisitions be in terms of an outflow from your balance sheet, and are you looking to raise any debt to fund these acquisitions? Because your net debt to EBITDA came down from around 1.5 to closer to 1. So the street is keeping an eye out on that ratio as well. If you could give us a sense on all of this.
We've always maintained that a comfortable ratio, net debt to EBITDA, is about 1.75 to 2 in this industry. Globally also, we've seen that. But we managed our working capital very efficiently. We've reduced our net debt by almost 230 crores. Our DSO, if you look, has reduced from almost 74 days, similar time last year, to now about 69 days. So we are doing all the efficient working capital management. But you're right, as and when the M&A cash flow investment arises, we will look at altering our debt. But typically the deals that we do, they are in the range of 51% upfront that we buy. So it is not an immediate cash flow. It is staggered over 2 or 3 years' time.
So would you be raising only debt to fund these acquisitions, or is there an equity fundraise also in the pipeline?
Not at these current prices, but we are always open to that in the future.
And what about the potential size of these acquisitions? I mean, we understand that you'll be paying 51% upfront, but typically what size do you acquire companies at?
So our M&A process is very, very defined. We look at anything not less than an IRR of 25% on the deal. It has to be a geographical fit or bringing certain niche skills to the group. Now, given these criteria, we might look at anything in the range of about 60-70 crores top line to 1,000 crores. And as of now, we are looking at the deals that are in these actual ranges. But a lower size deal would typically have a higher EBITDA percentage. So it'll be good for EBITDA accretive for the whole segment. And the larger size deals will, of course, add to the operating leverage. And so that is our approach, yes.
You've done a phenomenal job of, actually not answering what we wanted to get out of you in terms of an outflow from your own books. Yes, you've given us the entire range, 60, 70 crore to 1,000 crore in terms of a size. That's the big buffet. But, from how much will you pay for something like this is what we're trying to understand. Do you pay 2x sales, 3x sales, 4x sales? And if you could give us a rough range of the money that will be going out of your books because of this, it'll give us a sense of, how much you're looking to raise your debt by.
Sure. Typically, the deals that happen in this space are 7 to 8x of EBITDA, right? So that is one clear metric that will help you understand. If you ask for the kitty, we are keeping ourselves ready for about 100 to 200 crores outgo for the current requirements.
All right, Mr. Singh, thank you so much for joining in today. Wish you good luck for your potential acquisitions as well as for the road ahead as well. Time for a short break. But before we do that, there's some good news for our viewers. India's business news leader is now just a click away, introducing the all-new CNBC TV18 app, where you get instant access to breaking news, in-depth articles and financial world updates at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can scan the QR code as Mangalam just did, and the app is already on his mobile phone screen. Take a short break. We'll be right back.